The first half of this year has been challenging, to say the least. It feels like there's lots of uncertainty out there around interest rates, oil prices, a war in Europe, and we might still not be completely out of COVID. And at the same time, people are having to pay more for groceries and gas. They've also seen markets fall, and with it, the value of their investments, which might be adding to the stress levels. So in this mid-year review for 2022, I'll touch on the two economic topics that you've told us are on your mind most: inflation and recession. We'll then relate that to how the Founders Fund is positioned and conclude with our advice to clients today. So let's get into inflation first. What's worrying policymakers is that price increases have been across the world and across the board. Here you can see that of the 4 buckets that count towards inflation, 3 have spiked in the last year. Understandably, this is concerning because high levels of inflation signal an overheated economy and reduce our ability to afford things, which is why the Bank of Canada has raised interest rates to slow things down. But the central banks are also trying to walk a very fine line here. They want to slow things down, but not so much that it causes a recession. Certainly, recession fears have increased in recent weeks, and it's not just a matter of whether we'll have a recession or not, but if we do have one, how severe will it be? And this is impossible to answer without some benefit of hindsight, but what we can say is that the Canadian economy is actually in a decent position to deal with it. Employment is strong, and commodity prices are high, which helps Canada as a commodity producer. But what does it all mean for your portfolio? Well, as investors, not economists, we're trying to assess the risks or information in general that is already embedded in prices of stocks and bonds today, and whether that's appropriate or not. So if people are generally optimistic about something, but our assessment is that they're being maybe too optimistic, then there's a chance that the price may go down if we're right. And that's what we felt was happening at the start of 2022. Interest rates were extremely low. As we analyzed the situation, we felt that people were just underestimating the risks. Economic readings like employment, spending, confidence all seemed exceptionally strong. There didn't seem to be much reason to keep rates low. Low interest rates are useful when you're trying to stimulate the economy, but the economy seemed robust. So at that time, we elected to have 25% in bonds in the Founders Fund, well below our long-term target of 35%. And that proved to be a good decision because Canadian bonds have declined more than 11% this year. And since then, rates have risen significantly. In fact, bond yields are the highest they've been in years. And we find that investors are starting to act more reasonably, which is why we've been inching up our weight in bonds. Today, we hold about 30% in bonds. And a similar story is playing out in stocks. One way to estimate how much good or bad news is already built into stock prices is to look at how much investors are willing to pay today for $1 of profits in the future. And over the last 25 years, investors have been willing to pay about $16 for every $1 of profits for US companies. And we're using US markets because it's more diversified than our Canadian markets. So early this year, this number was up above 21, suggesting the market was getting expensive, and investors were willing to pay a lot more than the average. But with the uncertainty today, investors are only willing to pay about 15, lower than the long-term average. And this change is why prices have tumbled. But it also means that investors are already incorporating a lot of the risks that we've just been talking about into stock prices today. The holdings in our funds actually seem even more reasonably priced than the market in general, which is why the Founders Fund has increased its weight in stocks to 64%. We're not going crazy buying stocks here, but we are willing to hold more than our long-term target of 60%. And the remainder is in cash to continue to provide some buffer against volatility and just dry powder if we need to buy more. Within those stock holdings, we own many companies that might do well in periods of high inflation. Companies like Visa, for example, which just take a percentage of the sticker price. So as prices rise, its cut gets larger. Or Meg Energy, a Canadian oil company which benefits from this jump in oil prices. or Australian patent expert IPH. Because it's expert in what it does, it's able to easily pass on costs to clients. And there's many more examples throughout our funds. Of course, we can't just own stocks that'll do well with inflation because those companies might feel the pinch in a recession, which is why we also own healthcare companies like UK-based GSK. And we own Viscofan, a Spanish maker of sausage casings. Yes, you heard me right, sausage casings. We don't know if we're at the market bottom, how long inflation will last, or if we'll have a recession. Our focus is to make sure our portfolios are broadly diversified with an emphasis on well-financed, profitable companies that won't just survive the challenging times, but will come out stronger on the other side. As investors, you have a similar opportunity today. As we lay out in our most recent quarterly report, returns from this point are likely to be better over the next 5+ years. Now, each of you has a unique situation, and our advice will vary depending on your circumstances. But generally, what we're advising clients is stick to your target mix of stocks and bonds. And if you're invested in the Founders Fund or Builders Fund, we do this for you. If you're adding money to your portfolio regularly, this is not the time to waver. If anything, consider increasing the amount if you can. If you're retired, know that you too will likely be invested in the markets for many years to come. And if you use a cash bucket from which to draw a monthly paycheck, we suggest waiting, if you can, before topping up that cash bucket from your investments. And last, if you've got money sitting on the side, this is the time to start deploying. If you're unsure how to do any of these, book a meeting with us. We're here to help you. Long-term Steadyhand clients have seen plenty of market volatility in periods of negative returns, but have also enjoyed solid long-term returns that has built their wealth and financial security. Finally, if you'd like more details about the strategies each of our funds is deploying, please read the commentary we've linked below. Thank you for your continued confidence in us.